I think it's going to be a mess. And I think one of the, going back in history again, looking at, say, the 1940s, which is the kind of the closest macro environment, oddly enough, to the 2020s environment, that was the last time they tried to come off the zero bound. When they were on the zero bound, they had inflation, and they tried to raise rates off that zero bound. And, the question is, how do they handle it? And the answer was an absolute mess. They basically had to, they did yield curve control. They inflated away a lot of debt, and then they tried to slowly come out of that, zero yield environment back to, getting back towards positive real yields. And it took them quite a long time. And that was an environment with, partial capital controls. That was an environment of no social media. Things happen slower. So you can you get people into these silos and you can slowly change things. I mean, gold was banned for 40 years for Americans. It was kind of a weird environment. And essentially, in this, now we're in a fourth turning again, and essentially they're doing this. They're in the same environment where they're obviously trying to get off the zero bound in a very indebted environment. This time, I think the challenge they're running into is they actually took a different course in the playbook. Last time they did basically what Japan's doing now, the yield curve control, raise things slowly. This time they tried to rip the Band-Aid off and just jack rates up, and basically it's emanating into the banking problem, and it emanates into real estate. And I think we see these cascading problems. And I think the challenge is that they eventually face kind of a Minsky moment where they're not able to handle both at the same time, where they basically are in a situation where they try to normalize rates, but that they still have to end up providing liquidity to the treasury market and some of these other kind of core markets. And I think they're going to be in that kind of weird environment again, with the key difference being that we are in a different technological environment now, where we have social media, we have rapid real-time data, we have more free flow of capital, at least for the Western world. And I think that's the challenge they run into, is that they're essentially applying a 1970s kind of inflation fighting playbook to a situation that's actually more like the 1940s. And I think it will result in some pretty extreme outcomes. Essentially, yeah. I wrote an article about that months ago. Oh, you did? I wrote an article about that months ago because that chart that you posted, was floating around, and I dove into it because what that chart.
Mine was floating around.
That St. Louis Fed chart, one with the one you just showed, the remittances.
Yeah, exactly. Yeah.
And basically the problem with that chart, because it shows the problem, but so all those numbers prior to that going negative are weekly numbers. It's how much basically the Fed is sending to the Treasury every week, and then they change their calculation in the end there, and it becomes cumulative. Yes. And it kind of damages the chart. So I saw that Jim Bianco, he put out a really good chart that he made the whole thing cumulative. He took that data set and made it cumulative, and it shows that you basically have this line going up for like 10 years, then it starts to roll over. I made a chart where I was inspired by his work, and I made one that was both cumulative, and then I also showed the weekly ones on it as well. And I dove in an article about why this is happening to the Fed, what choices led to this, and that was a few months ago. And essentially, it's what you pointed out, that was almost a precursor for what we're seeing now in the regional banks. That the Fed has huge unrealized losses. They have, unlike most banks, they actually have an operating loss, meaning that their liabilities are yielding higher than their assets, which is historically very unusual. Now, unlike a normal bank, they don't have to necessarily make a profit, but over time, it does start to impact a number of things. One is it impacts the Treasury, because the Treasury used to get a revenue source out of the Fed. Now they don't get that revenue source anymore. And then longer term, if this goes on long enough and they dig themselves in a deep enough hole, it actually does kind of bring up questions around central bank independence, because kind of central bank solvency is kind of one of the factors that at least leads them to have some degree of central bank independence compared to what you get in kind of a banana republic where there's really no independence at all. So over time, if you were to have them hold that level for a sufficiently long period of time, and you have commercial banks have to slowly raise their deposit rates in order to compete with money markets and T-bills, you'd eventually have them all start to look like that sheet, essentially. They'd all start to have these kind of negative profitability, and they would start to eat into their capital. And so I think that they're going to have pretty insane decisions ahead of them, where sometimes they're facing both inflation and recession problems at the same time, or at least kind of back to back. And it's the worst possible environment for a central bank to navigate, because if they have a 1970s style problem with low debt and high inflation, the answer is to tighten.